Why does net income not equal the increase in cash? If we look at the income statement that we did 2 sections ago, we had $375,750 in net income. And if we look at the balance sheet that we did last exercise, the increase in cash from 2014 to 2015 is $200,000. So why the difference? What explains the increase in cash by $200,000? Well, we need to have another statement to help us with this, and that statement is called the cash flow statement. So what we're going to do is we're going to look at the actual income statement and balance sheet examples from the previous 2 sections, and then we're going to create a cash flow statement right now from scratch. Before we do that, though, let's just take a quick look at the 3 sections of a cash flow statement. So the cash flow statement is made up of 3 items as follows. Number 1, cash flow from operations. And this basically means stuff that has a duration of under 1 year, meaning stuff from the income statement and the balance sheet's current assets and current liability sections, except for debt. And I know that sounds like a lot, but basically, we're just going to look at the cash flow from operating our business for less than a year. Okay, so the income statement is always for a period of a year or less. And if you look at the current assets and current liabilities on a balance sheet, for the most part, those items all have a duration of less than 1 year. Okay, that's the first part of the cash flow statement, cash flow from operations. Remember, what we're trying to do here is to try to reconcile the difference between net income from the income statement and the change in cash from the cash flow statement. Okay, now what we do is we add cash flow from investing, and basically you go to long-term assets, and if we spent money investing in stuff like machines or land, then we're going to deduct that from our cash flow statement. So think of this always as cash in your pocket or cash out of your pocket. And remember a while ago I said that the income statement is a lie? Well, I was half joking because the income statement does not tell you the increase in cash. And neither does the balance sheet. The balance sheet will tell you the change from 1 year to the next in the cash balance, but it won't explain how to get that increase in cash. And that's why we're doing this exercise. That's why we're creating this cash flow statement. And the third part is cash flow from financing from debt or changes in common stock. Okay, and let's look at the previous 2 financial statements, the income statement and the balance sheet, and let's create a cash flow statement from scratch. Okay, let's kick it off with cash flow from operations. What we do is we always get net income, right? Because what we're trying to do is we're trying to say why the income statement is not a good representative of the increase in cash that we have. Okay, so we get net income. And then what we do is we add back the non-cash items from the income statement. So take a look there on the right and tell me what is not cash. Depreciation and amortization. Okay, those are non-cash expenses. Right? So it's not fair. It's not a benefit that we get for an increase in cash. It just decreases our taxable base. Okay, so we added that back. And then what we do, step 3, remember we're just looking at stuff that's less than a year. We go to the balance sheet's current assets and current liability section, and we get the non-cash items. So let's do that. Okay, so we've got accounts receivable. So check it out there on the right. Accounts receivable increased by $50,000, right? And that means that somebody owes us 50 grand from a sale we made. But we should not have gotten the benefit of getting that 50K in our pocket because we haven't received that cash yet. By the same token with inventory, we spent an extra 25 grand on it, so that should come out of our pocket. And then look down there on the liability section of the balance sheet. Accounts payable went up $5,000. And that means that we have 5 grand more in our pocket because we haven't paid that amount yet. So let's add this now. Okay, so what we get is we deduct those first 2 items because that's cash out of our pocket. And then we add accounts payable because it's cash in our pocket. And then what we get is cash flow from operations. Okay, so we're done with 1/3 now of the cash flow statement. And really try to understand why this is the case. Don't just memorize this, please. Try to look through the financial statements and understand why this exists. Why is it $310,750? What is the purpose of this financial statement? So if you understand finance and accounting statements, then you'll remember them. Don't memorize them, please. Okay, now we move on to step 2 of the cash flow statement, right? So we're going to look at cash flow from investing. We invested in stuff like we bought machines or land, and that's cash out of our pocket. So let's check it out. So of course we get this from the balance sheet. So let's do this. So there we go. We've got land. We spent 10 grand more in the past year on land and 50 grand more on the machine. And so that becomes 60 grand. Okay, good. So we're getting there. We're 2/3 of the way there now. So we've got one more thing to do in the cash flow statement, which is cash flow from financing, meaning if we got a loan or we had a change in common stock. All right, let's check this out. And so we get this from the liabilities and equity section. We can see that short-term debt went down. That's a good thing. We paid off debt, but you know what? That's $10,750 out of our pocket because we paid it back. Long-term debt went down by 100 grand again. It's good we're paying off debt, but that's 100 grand out of our pocket. And we issued $60,000 worth in new common shares. Let's just add all of that stuff up right now. And so for cash flow from financing, taking into account all of that, that's minus $50,750 out of our pocket. Most of that came from long-term debt. Okay, cool. Now let's add these three items together. And what do we get? There you go. That explains the $200,000 increase in the cash balance. That explains the increase in the $200,000 in our cash balance from 2014 to 2015. Okay? And I'll show you what that looks like on the balance sheet. Right? So there you go. $200,000. That explains the difference.